It's been quite an extraordinary week as far as the US dollar is concerned, going from safe haven to coming under severe pressure over the last number of days, ever since it became clear that the Federal Reserve was going to be pressured into cutting interest rates. The coronavirus has finally caught up with the markets, and we saw severe risk aversion over the course of the entire last week, and that has carried into the start of this week. The only period of calm actually coming, and the only bounce actually coming on Monday, when markets heavily priced in a lot more action from the central banks. Now, this was followed on Tuesday by a meeting of the G7 finance ministers and some central bankers to discuss the outbreak of the coronavirus, the spread, the economic consequences, and what the reaction should be. And it's become very clear quite quickly that that starts with central banks cutting interest rates across the board. We've already had the Reserve Bank of Australia cut by 25 basis points, but that was at an organised meeting. The Bank of Canada is meeting today, and the markets are expecting a 50 basis point cut from them as well. But yesterday, the extraordinary measure we saw was came from the Federal Reserve. They're due to meet in 2 weeks' time, and yet, at an out-of-meeting decision, they decided to cut interest rates by 50 basis points. Now, this, it's worth noting, was fully priced in by the markets, which is why the dollar came under considerable pressure even prior to that. The US dollar index falling from around 100, where it peaked at a couple of weeks ago, back to around 97 now. So it's in big moves in the greenback. The reason why we've seen those moves, it comes for a number of reasons. One, like I say, this is extraordinary action from the central bank, and markets are continuing to price in more. But in cutting rates in such an aggressive manner, what we're effectively seeing is we're seeing the removal of some of the appeal of the US dollar. The US dollar is never not going to be a safe haven. That goes without saying. It's still a world reserve currency, and US treasuries are still in abundance. So there's always going to be a safe haven appeal there. But one of the aids of the safe haven appeal for the US dollar and the US treasuries was the fact that they were yielding so much more than other bonds, whether we're looking at across Europe, here in the UK. We were seeing the US treasuries were yielding a far higher return. So that increased the safe haven appeal in times of insecurity in the markets. Well, now US 10-year treasuries have dipped below 1%. This is the lowest they've ever yielded, and that, by falling more into line with other developed market bonds, this effectively removes a little bit of that safe haven appeal, and that's really taken the wind out the sails of the US dollar and eased up the pressure on some other currencies around the world. Now, one of these where we can see this most clearly is against the Japanese yen. The Japanese yen, your traditional safe haven currency, but it has had some competition over the last couple of months from the US dollar itself because of that additional safe haven appeal. 109, 110 for a long time was seen as a major resistance level. Every time we entered that region, we seemed to see a cutback. Eventually, we did break through here and hit the kind of 112s, holding above that Ichimoku cloud. But ever since markets have started pricing in increasing Fed action, we have seen that dip, and aggressively so. 110, 109 was the first casualty, taking with it that Ichimoku cloud. Very quickly after that, we've seen the lagging line, which is seen as the confirmatory indicator, follow suit below the Ichimoku cloud, taking us right back into bearish territory here on this chart. The near-term price action, obviously extremely bearish, given the considerable fall and the rapid nature of it in such a short period of time. We're now trading back around the kind of 107 levels, 109, 110 now to the upside, a potential major barrier of resistance for this currency pair. But really, like I say, the fact that price action's broken back below the cloud, the fact that the lagging line has confirmed it, suggests that this is now looking much more bearish than it has potentially for some time. Below here, 105 stands out as the key level here. Every time we're trading back around these levels, we've seen it seems that 105 has proven to be a key potential area of support for this pair. If we break below here, then eyes will automatically be drawn back to the kind of 100 level. But ultimately, a lot of this is going to depend, as it has in recent weeks, on risk appetite in the markets. At the moment, markets are in very much risk-averse mode. We've seen a bit of a bounce at the start of this week in terms of risk appetite because of the actions of the central banks. In order for that to continue, I think we're going to have to see more central bank action, but also, and far more important, I must say, for more than just stabilising the financial markets, but from an economic standpoint, we're going to have to see some government fiscal action as well.